Morning. Today I am talking about decentralized exchanges in the context of centralized exchanges, and I will be diving into the market data. So before I go into the presentation, centralized exchanges no longer dominate the cryptocurrency industry. And we've seen this narrative throughout this entire conference over the past year, but I like looking at data more than narratives. So today I'm going to look at trends in market data rather than look at the narrative as a whole, because while the decentralized finance industry is definitely innovative, there are still a lot of work that needs to be done, especially in the decentralized exchange space. So before I get started, a bit about me and about Kiko. My name is Clara. I lead research at Kiko, which is a cryptocurrency market data provider. We were founded in 2014, and for the majority of our existence, we have solely collected data from centralized exchanges like Binance, Coinbase, Gemini. But over the past year, we've spoke to more and more investors who expressed interest in DEXs like Uniswap and SushiSwap and Curve. So we made a big DeFi push starting last fall, and now we collect data from 2 DEXs, SushiSwap and Uniswap, and we have many, many more added in the pipeline. So at Kiko, our main job is to collect, normalize, and distribute this data, and our main clients are institutional investors. So we collect data from 2 types of exchanges, of course, a centralized and a decentralized exchanges, but each type is very different. So before I get into the actual data, I'm going to quickly go through the main differences and similarities between the 2. So first, a centralized exchange is, of course, centrally managed. The exchange controls your assets when you send it to an exchange. You do not have any ownership. There's listing fees and extensive due diligence before a token pair starts trading. There's regulatory jurisdictions, KYC, AML rules. It's quite difficult, actually, and this is simply because it's a centralized financial entity, and they must abide by rules no matter which jurisdiction they're in. On a decentralized exchange, it's all different. It's completely by nature decentralized and operates on a blockchain. Most common is the Ethereum blockchain. You also control your assets. At no point does a DEX like Uniswap control your assets. You will always have the power over them. Not only that, anyone can list a pair on a DEX simply by creating a new smart contract. There is no regulation or KYC, but that also means that there's no control over the order flow, meaning no one is actually monitoring trade data or order books or the liquidity pools to make sure there's no malicious behavior. So how is this data actually provided by each exchange? On a centralized exchange, we collect data from public REST and WebSocket APIs. All exchanges have public access to market data today. However, many exchanges don't actually store this data. Therefore, a data provider is very important for making sure we collect and store data so that the rest of the industry has access to clean data feeds. But that's all different on a DEX. By nature, every transaction and liquidity event is added directly to the blockchain network. Therefore, you can actually go directly and browse the Ethereum blockchain network and find every individual transaction that happened on Uniswap. So what does that mean for a data provider? That means we actually have to build blockchain data infrastructure in order to scrape the Ethereum blockchain to collect these data feeds. And I really believe that as DEXs and centralized exchanges converge, market data providers will increasingly need to build blockchain data infrastructure in order to really capture the trading activity in the industry. Now, how can we actually compare a centralized exchange versus a decentralized exchange? So it's important to understand a bit the architecture of how these exchanges actually operate. On a centralized exchange, how does a trade happen? You pretty much have market makers placing bids and asks on what's called an order book. When let's say I'm a trader, I want to buy Bitcoin, I will place what's called a market order, and this order will be matched to either the best bid or the best ask on the order book. Liquidity is actively managed, and you actually need to be quite sophisticated in order to be profitable as a market maker. Almost all liquidity in crypto is provided algorithmically at this point, and it's by these big market-making firms. And so there's definitely huge barriers to entry to providing liquidity on a centralized exchange. And that's all different on a DEX. And that's the biggest difference between these 2 types of exchanges is how liquidity is provided. On a decentralized exchange, liquidity is almost always provided passively. And of course, I say almost always because more and more DEXs are like creating new opportunities for providing liquidity that are a bit more sophisticated. Most notable, of course, is Uniswap v3, but I'll just, for this presentation, assume that liquidity is passive on a DEX. And so what does that mean? It means that in order to provide, let's say, the bids or the asks for a trading pair, you simply deposit pairs of assets or multi-asset groupings into what's called a liquidity pool. So this liquidity just sits in the pool until a buyer or a seller comes by and wants to actually swap their assets. So price discovery happens through the swap of these assets, and market makers in DEXs, they're actually called liquidity providers, they're actually quite passive and they don't really influence the price of the asset. So again, this presentation isn't about DEX market architecture. It's definitely complicated and it varies from DEX to DEX, but the key thing to remember is that the difference between how these exchanges operate is how liquidity is provided. So today I will be analyzing trade patterns on 4 exchanges. I'm talking about Uniswap, which is the largest decentralized exchange by far. It has the highest volumes. You have SushiSwap, which is, I think at this point, a top 3 exchange, but it's a direct fork of the Uniswap protocol. You have Coinbase, which is the largest regulated exchange, and then you have Binance, which is by far the largest exchange globally. Today, I'm only going to be looking at the highest volume pair on each exchange. So why only the highest volume pair? Why not the entire volume of each exchange? This has to do with the difficulties that come with aggregating volume data on DEXs. Because anyone can create a trading pair, there are thousands and thousands of trading pairs, often with little to no liquidity on Uniswap and SushiSwap. And not only that, the actual collection methodology for getting and aggregating this data differs according, like, data provider to data provider. So if you look at volume of Uniswap on CoinGecko and compare that to volume of Uniswap on Uniswap and volume of Uniswap on CoinMarketCap, you will always get 3 different numbers. And this simply has to do with the different methodologies for aggregating this data. So in order to form a stable basis of comparison, I simply selected the 4 highest volume trading pairs, so the highest volume pair on each exchange. On Binance, that's Bitcoin Tether. On Coinbase, that's Bitcoin Dollar. And on Uniswap and SushiSwap, it's the USDC Ethereum pair. So the first chart I did is, so it's actually weekly volume. I simply charted the weekly volume for the highest volume pairs on each exchange. And what we can see is very much expected. Binance dominates, Coinbase is number 2, but you can see a little bit Uniswap and SushiSwap. They appear starting in May on this chart. But yes, let's zoom in a bit, and here we can see the cumulative volume since September. Again, Binance has processed a massive amount of volume for their BTC Tether pair, more than nearly $900 billion, and everything is converted to USD. Coinbase, a little more than $200 billion, and Uniswap and SushiSwap, it's quite impressive considering DEXs only became popular last summer. They've already processed many, like, double-digit billions for the highest volume pair. So it is impressive how far DEXs have come, but when looking at the data, you see that centralized exchanges definitely still dominate I would say the top-tier assets, which are Bitcoin and Ethereum. So I'm going to skip this and go back. But the next chart I want to look at is trade count. So again, this is weekly trade count, not daily. Trade count is something that I have not yet seen any data provider or researcher analyze. And this is because most other data providers are simply looking at aggregated volume statistics. At Kiko, we collect every individual tick level trade. Therefore, we can actually quantify the number of trades that happen for each trading pair. So here I've charted the weekly trade count, nearly identical chart, but we notice a different trend. We can see that the ratio of centralized exchange trade count to decentralized exchange trade count has fallen. DEXs have a very, very small percentage of total trade counts. And if we go back and look at volume, you notice that that ratio is just a little bit higher for DEXs. So right now, we know that trade volume has been increasing on a decentralized exchange. They definitely have since September. But trade count, on the other hand, there's something weird going on. Here I've charted the trade count on DEXs compared to CEXs, and they're right next to each other because of the huge difference you can't really tell in the previous chart. So here you can actually get a better basis of comparison, and you can actually analyze the trend line in trade count across these two types of exchanges. So let's just look at Binance. For the Bitcoin Tether pair, on average about 2 million trades every single day are executed. On Coinbase, it's a bit about 500,000 a day. On Uniswap, it's only 5,000 to 10,000 trades a day, and on SushiSwap, even less. It's about 1,000 to 2,000 trades a day. And again, this is for the highest volume pair on each of these exchanges. So another thing to point out is the trend line. On Binance, you see a very clear trend. You see an increase in the trade count from October to April. And on Coinbase, you see a similar increase. Trade count has nearly quadrupled on Binance. But now let's look at Uniswap. What's going on? Since October to April of this year, you see a slight surge, but overall you can pretty much draw a flat line through that curve. So we see that volume has increased on Uniswap and SushiSwap, but trade count has nearly stayed the same. So how is that possible? On centralized exchanges, the ratio between volume and trade count almost always stays the same. When volume increases, trade count increases, but on DEXs, we don't see that happening. So let's see why. Right now, I'm going to take the ratio of volume to trade count, which is otherwise known as the average trade size. The average trade size is simply the average volume in dollars of every transaction that happens over the course of one day. So here I take a 30-day moving average of the average trade size, and you can see it's quite a fascinating chart. On Binance and Coinbase, the average trade size is about $2,000 per trade, and it has stayed very consistent since July of this year. But when you look at Uniswap and SushiSwap, it's completely different. You see spikes, you see drops in trade count. Not only that, you see a massive surge in the average trade size. So what's going on? If volume is increasing, trade count is staying flat, of course the only way that can happen is if the average trade size is also increasing. So here I take the average trade size for all pairs on the exchange just to make sure it's not only happening for the USDC ETH pair. So here I take thousands of instruments trading on this exchange, and then I take the average. And again, it's very high. On Coinbase and Binance, the average across all trading pairs is just about $400 to $500. On Uniswap, the average peaked at more than $15,000 a trade. On SushiSwap, more than $25,000 a trade. And again, for the highest volume pair, it peaked at $80,000 a trade. Just so you get an idea, that is massive. That would never be able to happen on a centralized exchange. And so first, why is this happening? My next chart shows a very similar curve. I have the Ethereum network transaction fees, and you can see that there is nearly a direct correlation between the DEX trade size, the average trade size on a DEX, and the Ethereum transaction fees. So here I overlaid the average trade size with the Ethereum transaction fees, and you see that trade sizes surge when transaction fees surge. And this makes sense. When I first looked at this chart, I thought, okay, of course, if the transaction fees on Ethereum are high, that means fees for trading on Uniswap and SushiSwap will be a lot higher. Therefore, it automatically self-selects for high volume traders. If I'm a low volume trader, I only want to buy, let's say, $1,000 in Ethereum, it's going to be economically unfeasible for me if the Ethereum trade size transaction fee is so high. But then I thought about it. If that were the case and Ethereum transaction fees were causing average trade sizes, that doesn't really make sense. You would assume that in these periods of low transaction fees, that the trade count would increase. Low fees, and there would be an inverse relationship between the Ethereum transaction fee and the actual trade count. But again, when I showed you that chart, trade count is actually flat. So what's going on? Then I thought, what if it's a chicken and the egg problem? What if it's Ethereum average trade size, what if it's Uniswap average trade sizes that are actually influencing Ethereum transaction fees rather than the other way around? So how would that happen? And this has to do with a concept called front running, and this is one of the most, talked about issues with trading on a DEX at this time. And so what does that mean in the context of a DEX? So front running, by nature, a decentralized exchange is completely decentralized and every transaction is public, meaning anyone can monitor transactions before they are actually added to the blockchain. So transactions sit in what's called the mempool, and this is on the Ethereum blockchain. And so if you're a trader and you want to get ahead of a large trade, you can actually place a trade in front of a transaction you see by raising the gas fee. So let's say you see a large trade that's about to happen on Uniswap, and you want to front run that trade. You'll do that by incrementally increasing the gas fee so that you pay more and so that the miner is incentivized to add your transaction to the blockchain before the large trade that you see. So what happens if you have many traders that want to front run at the exact same time? You get what's called a bidding war. And bidding wars happen when the gas fees of traders, they're mostly bots, they're just bidding back and forth, and they're incrementally increasing the gas fee until one drops out and one becomes the front runner. After that happens, then the front runner will instantly execute an opposite transaction after the first trade happens. And so that's how they profit. Through front running. And it's a little more complicated than that, but for the scope of this presentation, I'll leave it at that. So to summarize, DEX transaction fees and DEX average trade sizes could be influencing the transaction fees of the entire Ethereum blockchain. And so there's definitely a lot more research that needs to be done on this, but I thought it was fascinating to see that on both Uniswap and SushiSwap, you see a very similar trend in the average trade size. And again, going back to DEXs and transaction fees, everyone knows it is very expensive to transact on the Ethereum blockchain. High gas prices make most transactions on the blockchain economically unfeasible for low volume traders. And this ultimately is exclusionary. If I want to buy only $1,000 of Ethereum, then I'm going to go to Coinbase, where I know I have a stable transaction fee. And this begs the question, who is actually trading on a DEX? If front running is such a big problem, is it only arbitrageurs that are trading? Is it only front runners that are trying to extract maximum value from every transaction? And this is an open question. I'm not fully sure. More research needs to be done. But it leads me to my final slide, which is that market data is greater than narratives. When we look at average trade size, it shows there is a big divergence between what you see with volumes and what you see with trade counts. And this is interesting because most data providers only have access to aggregated trade volume, and so this makes it difficult to actually analyze trends that are happening at the tick trade level. And ultimately, trade count, the fact that it's nearly flat on Uniswap for the highest volume pair, shows that DEXs still have a very long way to go before catching up to a centralized exchange. And ultimately, transaction fees still pose a significant barrier to widespread adoption. But at the end of the day, the DeFi industry and DEX industry continues to innovate at a rapid pace. You see on Uniswap v3, you now have more options for providing liquidity. Not only that, transaction fees are actually going down because of this. And so ultimately, I see convergence of decentralized and centralized exchanges. But for now, there are still lingering problems. So thank you very much.